The clock is ticking on commercial multifamily loans. What does that mean? The loans are going to come due and interest rates are much higher. So are you, the real estate investor, prepared for the deals to come? Make sure to watch today where I interview David Guevara, commercial broker, and we tackle this subject. Hi, my name is Juan, president of Sage Real Estate, the highest rated multifamily brokerage in Long Beach. Let's get right into it. Hey everyone, really excited about today's new video. I'm here with David Guevara, who is a local commercial lender. He's been doing loans in Long Beach and in Southern California for many years. Well respected, tons of knowledge. David, tell us a little bit about yourself.
Thanks for having me, Juan. Like you said, my name is David Guevara. I work with Momentum Capital Group, based out of Newport Beach. We focus primarily on multifamily and commercial lending in Southern California, but we can go nationwide. The bulk of what we do is multifamily lending for 5 or more units here in Long Beach in the South Bay.
Awesome. Thanks, David. Thanks for being here. We are going to cover commercial loans. So for those of you watching, I know typically I talk about fourplexes and that kind of stuff. Today is going to be a little slightly different because it's a very hot topic and it's 5 units or more. Okay. And so what we've been hearing in the news, I know because a lot of you have been reaching out to me, is we read that 1.5 trillion wall of debt within the US commercial loans are coming due. So a lot of us are hearing loans are coming due, commercial loans are coming due, commercial loans are defaulting, and we're hearing all this stuff in the news and people are reaching out to me saying, Juan, is this true? So we're gonna break that down for you. And so we'll just take it from the top. David, talk to us on why a commercial loan for a 5 unit and above, how are they different than what most of us would consider a traditional loan?
Yeah, so they're different basically in two different aspects. They're different on how they're underwritten, which is how they're analyzed and how they're approved, and they're also different on how the terms are of the loan. And so the way they're underwritten, whereas on your single family home or your 2 to 4 unit property, those loans are underwritten based off of the borrower's income.
Okay.
And so in order to qualify for a loan, your personal income has to be high enough and meet a certain debt to income ratio. On the commercial side, the primary source of repayment for the property is the property itself as the business. And so when calculating the loan amount, the maximum loan amount that a property can have, you're first and foremost looking at what does the net operating income of the property support for a loan amount. So that's first and foremost how they're different, is how they're underwritten. Also, they're different based on their terms, which essentially on a 1 to 4 unit property, you're looking at a 30-year fix for most loans and no prepayment penalties. It's a principal and interest payment. Commercial loans vary quite a bit from bank to bank. And a lot of times you're seeing a 3-year fixed, 5-year fixed, 7-year fixed, or 10-year fixed term. You can have interest-only payments. A lot of times they have prepayment penalties on them if you're paying it off before the fixed period expires. And so there's a lot more variance between one loan and the other. But the main takeaway that we're going to be talking about today, I think, is the fact that those loans are not fixed for more than 3, 5, 7, or 10 years.
Got it. So what is happening is, or what the news is telling us, is that all these commercial loans are now coming due. And the reason why it's a little different now than before is that the interest rates are much higher. And that gives people a lot of reason to think that could this be the end, or could this be the beginning of a bubble bursting? And we're going to get into that. So David, why is it that things are different now? And why is it that folks are more alarmed now than ever before? Like, what has happened?
It just has to do with the speed at which rates increased. Historically, a 5, 6, 7% interest rate isn't that crazy. We've had rates much higher than that in the 70s and 80s, 90s, and early 2000s. And so the actual rates themselves are palatable. The part that makes it difficult and that's causing potential issues is how quickly they increased. So somebody that got a 3% interest rate in 2020, late 2020 or early 2021, that's now going to be, potentially adjusting in the next couple of years, because they're underwritten based on the income. If the income didn't increase significantly, there's a potential that they could not be able to refinance for the same amount and have to bring in a bunch of money to be able to refinance, or that their payments are going to increase so much because it adjusted
Right.
so quickly. And so it's the speed at which the change happened, not so much the change itself.
Got it. So for those tuning in, obviously, if you own a fourplex or that's what you're looking to buy, and that's one of the reasons why we actually push for newer investors, at least, is to start off with a fourplex. You know, we say 4 doors to more doors, right? Because it's kind of the gateway to getting started. If you own a 4-unit building, you don't care about this. You're watching this video saying, well, my interest rate is going to stay the same for the next 30 years. I know my payment and I'm good. And so congratulations, that's a great position. When people start scaling, right? So when you start growing and wanting to take on bigger investments, you want to become wealthier quicker, you start doing commercial loans. And so in this one specific instance, we have these loans coming due, which what David said, there's nothing different than that happening. Loans come due all the time. But now loans are coming due and the interest rates are more than double than what they were when they first took them out. So talk to us, David, of what could happen? Like what's going to happen to that person who got a loan at say 3.25 and now it's 2023 and they're looking at this and their interest rate is going to go up to say 6%.
6%.
6%. Give us an example of what's that going to look like for that specific investor?
A lot of it's going to depend on what their original loan looked like, what kind of terms their original loan had. But assuming that it fell into somewhat of a normal category of an initial 5-year fixed loan with principal and interest payments, and then now it's going to adjust after year 5. In month 61, it adjusts to the new interest rate, which is almost double what they had. You're looking at potentially a payment on a $3 million loan, you're looking at a $12,000 payment a month that is now going to jump and get re-amortized at 25 years of remaining amortization on year 6 with an interest rate of 6%. You're looking at that $12,000 or $12,500 payment jumping to $19,000 or $19,500. And so that's a huge gap, a huge jump in payment that you hope will be made up by an increase in rents that's happened over the last 5 years, but a lot of people didn't do that.
Right. So this is a perfect scenario where if we stop there and if I tell you this one investor bought a building and their mortgage payment is going to go from $12,000 to $19,000, that would make you think, oh my gosh, they're in trouble. Okay. And so now David, and I agree with that sentiment. I too would think they are in trouble. I'm glad I'm not them. That's what I think. Okay. What are their options? So for that specific person, because there's going to be a lot of those folks, what can they do? Because their interest rate is going to go up.
So if that person has to make their decision today, if they got their loan 5 years ago and it's adjusting today, you want to see a couple of options that you can do is you can refinance at the higher rate and you can bring in additional funds, additional money to be able to still meet the debt coverage ratio, which we'll talk about a little bit more in detail, to be able to refinance with the new interest rate and lock that in for the next 5 years. But it'll probably require you to bring in more cash and pay down the loan a little bit.
Can you give us an example of what bringing in more cash means? Like
Sure.
how much, what can happen?
So a loan that was originated at 3%, a $3 million loan, let's just say, that was originated at 3%, and had that $12,000 or $12,500 payment, jumps to $19,000 or $19,500. You're looking at, in order to meet that same 1.2 debt coverage ratio, which is similar to what a DTI would be for a 1 to 4 unit property, a debt coverage ratio is what they use for commercial properties. In order to still meet that same debt coverage ratio that banks will require, you're looking at paying down a $3 million loan about $850,000 to $900,000.
Okay. So here's the, I guess the next warning number 2 is that means that this investor, in order to keep that property, in order to refinance it, they need to come in with $800,000 down. Now, that's not going to be every investor because it's all going to be based on the amount of debt that they took on, the amount of loan that they took on. But in this case, you have to wonder, well, how many investors have that additional $800,000 or somewhere around there to continue owning the property? So we have interest rates going up, which would be alarming, I think, to anybody. And then we also have in a situation where The option of keeping that property means you have to come in with another $800,000. Those two things alone I would think would trigger people having to sell.
Right. And keep in mind that that's assuming that rents are the same as when they originally bought it. And over the last 5 years, there's been some rent growth. You would imagine some people have accessed some upside. And so if the NOI, the net operating income of the property, has increased, that would lower that $800,000 number somewhat. But we're just running it apples to apples. If the income hasn't changed, that's the amount of difference that you're looking at.
Right. So we've done some research and we've checked in with several people, whether they're investors, other commercial brokers. And what I'm hearing, David, and you tell me if this is incorrect, pretty much the situation we've painted right now to me would seem somewhat of a doom and gloom.
Right.
Payments go up from $12,000 to $19,000. That is scary, right? So if I'm in that situation, I'm scared. And if I'm in that situation of now your new payment is going to be $19,000 and you have to come in with $800,000. Okay. Now, granted, this is somewhat of an extreme situation, but it's not as extreme as we know that if rents didn't really go up, you're going to be in that situation.
Right.
I'm being told that the majority of these loans that are coming due in the next 5 years, starting this year, that the majority of those investors will not be in this panic phase. Can you talk about how is it that they're going to look at this?
The investors that bought 5 years ago or bought 4 years ago and their loans are becoming adjustable in a year. We're assuming a 5-year fix for most of these because that's the majority that we're seeing in this market. But there are 7-year fix and 10-year fix and 3-year fix. And so there is some variance there. But for the investors that bought 3 or 4 years ago that still have a year or two left, they've purchased at a time where there was a tremendous amount of rent growth in the market. And so they have time to increase rents. They have time to build ADUs, to increase their net operating income by one way or another, either by increasing rents or adding units or whatever it is. And so by the time that 19,000 number hits, they'll have had time to increase their rents enough to now cover that, and they won't have to bring in as much or potentially any money in order to refinance. And so that's possible. The other thing that they can do is if they bought a stabilized property without a lot of upside, or they've already accessed their upside, what they can do is potentially sell that property and buy into a property with more upside that they can access and then cover themselves that way. And one way or another, they'll likely have to put in more money into the deal, but maybe they find it more valuable to put money into a deal with more upside rather than put money into a deal that's already tapped out.
What's the advice that we're giving these specific folks? So if you're a seller, so you own this property, it's coming due, how much time do they need to really prepare for the, and I'm sorry, I keep using the term coming due, it's actually adjusting. In most cases, these loans will adjust, and the term they use is it rolls over. It rolls over from your prior really low interest rate, it rolls over into the much higher interest rate if you don't refinance. And so those are the options. But how much time would you tell a seller that they need to speak with you and explore those options if they want to continue owning the property?
I would say it's always a good idea to reach out as quickly as possible to get an idea of how much, assuming the rates stay where they are today of 6%, how much more does my property income, my gross income need to increase in order to be able to support a new payment of that $19,500?
Right.
And so the earlier they reach out, the better, because everything takes time. Rent increases take time. Rehabbing units and increasing rents takes time. Building ADUs takes time. And so learning that and running that scenario as quickly as possible is going to be the best way to set yourself up for the next year or 2 years or 3 years, whatever it takes.
Yeah, and I like that suggestion. Is that if you come to David, it's not, the answer is not always refinance. It sounds to me like you're going to be able to advise and consult them on what they can do to raise the income, right? So like strategic moves. And so when you bring up ADUs, those are accessory dwelling units. That is building additional units because the state of California is allowing us to do so. And by building additional units, you now have more income. So therefore it lessens the spike of payment if you have more income coming in. So I highly recommend that you speak with David when it comes to what are your options, okay? Now, part 2 of that is also speaking with a broker like myself.
Right.
One thing that you need to know if you're a seller, because those are really the two options. Well, there's really three options: is refinance. Your second option is, before you refinance, is make an improvement so that your refinance is acceptable to you. And then third, explore what the market's doing. And I could touch a little bit on, we are seeing at the commercial level properties sitting on the market much, much longer. Buyers wanting a drastic discount, not a slight discount, a big discount, or otherwise they're not selling. And so I've described the situation to a lot of folks as a complete stalemate. Sellers not budging, they don't want to lower the price, but the buyers aren't budging either, and so they're just stuck. Something's got to give. And so you need to know that if you're thinking about selling, what is your property worth now? I'm not saying it's worth less. I'm simply saying that it's taking longer to sell. There's going to be more properties on the market as more and more people think that might be my only alternative if they decide not to refinance. And so having these conversations early on, super important. And I recommend you speak with both of us. Now, David, let's go on to the second issue, which I see, and this is bridge loans. And I'm going to describe a little bit of what that is, and then I'll let you give us some advice. So the first example that we talked about was rates increasing, adjusting. That's the term. Okay, rates are going to adjust on these terms. Part two of that is not everyone got a 5-year loan. Some people got a much lower loan, okay? So for like 2 years, 3 years, and who was getting those loans? Okay, so the majority of investors that were getting those loans are known as syndicators. And syndication is a topic that we've covered in a prior video. And so just to let you know, those are groups of people that come together, and there's typically one main person called the sponsor, and that person oversees the project, utilizes some of their money, but most of your money to be able to make this. Super popular. It's a great way to get started in investing, especially if you don't want to do the heavy lifting, as the sponsor will do the heavy lifting. Those specific people are known as syndicators. What they're doing is perfectly legal. Now, they made up a lot of the purchases the last 3 years, a lot of them. And what I'm going to tell you is the majority of them, 9 times out of 10, got a short-term loan. Okay, those are what they call bridge loans. And that is where I see a bigger issue than just increases of interest rate. David, can you talk to us about bridge loans and what you see happening there?
Sure. So the bridge loan market varies quite a bit. There are bank bridge loans and there are hard money or private money bridge loans. A lot of what happened on the smaller space were private money bridge loans, which are fixed and interest only for anywhere between 12 to 24 months. And they were just based off of, the exit value and the exit refinance or the sale. And those numbers were based off of a smaller increase in interest rates. And so a lot of those syndicators and those buyers that purchase with hard money bridge said, okay, the rents are this, there's a lot of upside on the property. As long as interest rates stay around 4.5%, assuming they were 3% at the time they bought, then I'll have more than enough room to be able to refinance out, or I can sell the property at reasonable cap rates that we'll see today. What's happened though is cap rates have increased, which for a seller means your value has decreased a little bit.
Correct.
And then also interest rates have gone up much more than what a lot of those original estimates were. And so a lot of those investors and those syndicators are in somewhat, or either are right now or are going to be in somewhat of a pickle because they don't necessarily have enough room to be able to refinance or sell at a profit. And so they're going to have to, make some moves pretty quickly because they're dealing not just with their own money where they can sit there and take the hit, they're dealing with investor money.
Yeah.
And so there's a little bit more of a squeeze there. And as far as bank bridge loans go, those typically aren't fixed. They roll over every 30 days. And so it'll be a 3-year loan that every 30 days readjusts to the market rate. And so those properties, they don't have to wait to feel the squeeze. They're feeling the squeeze right now. Those rates have already adjusted.
So the reason for this video is that we wanted to show you if you're in a position where either you're a syndicator or you're a seller, here's what you should do. But this is where I see opportunity for the new investors coming in. When David uses the word the squeeze, they're feeling the pressure. In some scenarios, and he said that interest rates in certain types of loans are adjusting every 30 days. That's pretty scary. That means you never know what your payment's going to be. And chances are the income is not the income is going to be pretty constant and it's not going to change. And so those people who bought, and I would say, would you say the last 2 years are the ones, the last 2 to 3 years bought and utilized a bridge loan are the ones that are going to be in the toughest position out of everybody.
Right.
Yeah.
Right. Yeah.
And so what are their options? Like, what are they thinking right now? Shoot, this is what I need to do now.
Yeah, they're potentially looking at selling the property and buying something else with more upside, or holding it longer and potentially needing to refinance and bring more money in. A lot of those syndicators are having to make capital calls and calling their investors and saying, "Hey, the deal's still sound, but what we had originally raised capital for, we've gone through that capital. Now we're going to need more to pay it down, and we'll have a lower loan amount." And so there's a lot of that stuff going on, and it's going to probably be increasing over the next few years. I would assume as well.
Right. And it's with that increase is I think we both believe that we're going to see an increase in inventory, meaning that these sellers, maybe they were going to sell, or maybe they're having to sell a little sooner than they wanted, based on the pressures that they're feeling financially. So if you're an investor, hang tight, because I do believe that there's going to be good opportunities coming up. Okay. So some of these some of the folks who bought under a bridge loan, when I've interviewed them, and they're saying, well, when that loan comes due, we'll just get another bridge loan. Talk to us about the possibility of that even happening.
It is possible, but I don't think it's as likely as a lot of people think. Okay. Because the bridge loans, while they don't do a heavy underwriting process or analysis process on the way that the property is performing at the time that it's originated, basically what they're looking for is, what's the way out of this loan? What's the exit strategy is what they call it. And so that can be either selling the property at a profit, or it can be refinancing the property based off of some future higher income that's going to support the same amount of debt. The problem is those properties a lot of times were purchased based off of a market environment with lower cap rates. And so now the cap rates have increased a little bit, or now the interest rates have increased so much, both the sale exit and the refinance exit have become much more difficult to achieve. And so there will be a lot of bridge loans that they try to go and get re-originated, and then they say, okay, well, how are you going to get out of it? And while before they said, well, this higher income is going to get me out of it, now it won't, because the rates have gone up so much.
Right. So again, that is a situation that we're going to see as this unfolds. Both David and I are tracking two things, right? So we're tracking loans that are coming due, because that's an important. So the more loans that come due, the more potential opportunity. And I think potential opportunity for both, not just us as businesses on the lending side, on the real estate side, but also you, the investor. More inventory is a plus for you. We've gone back. A lot of the data that we'll see, that you see, that we see, is national data. Okay. But what we've done a little research for us, and we've used the help of CoStar. And what I wanted to find out and bring to you today was, how many loans are coming due in the next 12 months in the city of Long Beach, right? Let's give us a real life view of how large or little that number could be. Because if you base it on the headlines, you're assuming that everyone's loan is coming due today, and that's not the case. Right. So let me lay out the situation for you. In the city of Long Beach, there's roughly 7,500 apartment buildings, okay? And in the next 12 months, we have 159 loans coming due. That's not a scary number, is it?
No, that's manageable.
That's manageable. So would that not all 159 would hit the market, right?
Right.
Because some of them they're going to have options, right? They're going to refinance through you or someone like you. But some of them will. Now, what we don't know right now is, off the 159, how many of those are going to be able to refinance and be okay with the higher cost of owning it, and how many of those percentage-wise are going to have to go to sale. So that's something we're tracking. It's an interesting thing, but we'll see. Now, the one thing that I want to tell you, because David brought this up to me, and he said, hey, Juan, but look past the 12 months. Because year 2, year 3, year 4, year 5 might be different. And so what we're seeing is, where in the next 12 months, we're at 159. The following 12 months, you're at 214. And the number keeps going up. We're at 269, 365. Now, this is ending up in April of 2028. We have 525 loans coming due. So the number just keeps going up, which coincides with the type of loans that these investors were getting, right? So that's almost year 5 from now. And so talk to us about what you make of that and what we could do to prepare ourselves to really take advantage of these potential new deals.
Yeah, I think the best way to prep for that, especially if you're one of the people that has a loan coming due in 2026, 2027, 2028, is you've got time to increase your rent, but be on top of it. You need to make sure that you're issuing rent increases, that when somebody moves out, you're rehabbing the unit and renting it for as much as possible. If you can build an ADU and you want to build an ADU, I wouldn't wait 3-4 years. I would just do it now. I would access the highest income that you can access from your property, maximize your net operating income as quickly as possible, and maintain it at that higher amount, so that if we don't experience this big boom in rent growth, if something happens or you decide that there's a good opportunity, you want to sell or you want to refinance before that 5 years is up, you have the option to do that. Because right now, income, it always has been in commercial, income is king, and that's the best way that you can get the most out of your property.
David, next I want to tackle foreclosures. That's a term that I haven't used at all in this video. You haven't used at all either. But I know that watching the headlines, we hear foreclosures. We know that in Houston, a very large syndicator got a property foreclosed on, right? So this was over $220 million. This is at the very largest of largest levels, and that got foreclosed on. And why are we not talking about foreclosures today? Like, what is it that you're seeing?
Those examples that you talked about, like in Houston, it kind of goes back to the bridge conversation that we were having. Is those big funds and those big syndicators bought a lot of property with bridge debt that was floating, and if you bought with a bridge loan that was at 3.5%, and now it jumped up, and you don't have any kind of fixed period or any kind of cushion to cover yourself while you're fixing up the property, while you're adding value, you get stuck in the middle. And so those are the kind of deals that you're starting to see foreclose, or be in a lot of trouble, or fire sale, that kind of stuff. But the properties that are on 5-year fixed loans, or even the ones that are on hard money, like private money bridge loans, that are fixed for 12, 18, or 24 months, and people are building ADUs, stuff like that. Those are the ones that we're not seeing issues with them yet, and we may never see issues with them. They may be totally fine, but it's the ones that you're hearing about in the news those are the ones that bought with those bank bridge, those adjustable rate loans, and traditionally they haven't been a problem, but with as quickly as rates have gone up, it's become a problem.
Right. And so some of our research has shown that because the news is covering at a national level, we're being told that scenario of foreclosures is probably going to be a little more prevalent in what they call the Sunbelt states, which is like just the Southwest through the Southeast. Those were areas where they built, and they built a lot. So developers went out there and they built a lot of multifamily. Syndicators went out there and they started fixing up what they would call the C class, so some of the older buildings. And they were fixing up nicely. They were improving the property, increasing the rents, and then they were selling them. They were super successful. This happened for years. But what ends up happening is a lot of people go there and say, it's easy to make money there, we should all syndicate. And then you have a lot of people there now, and the economic environment for that type of investment has changed. Right. And we've just laid that out for you today. So in those situations, their exit plan of I'm just going to sell it and be fine may not be the case, because maybe it's not worth what they paid for it. And that's what we call underwater. Now, again, that's going to be more prevalent in those types of states. So we're going Arizona, New Mexico, or Texas. A lot of people went there to do investments. And that's where we're going to see the biggest problem with those getting foreclosed on. But in Southern California, if someone wants to sell, there's still a buyer who wants to buy.
Right.
In Southern California, there's still demand for rental properties. There's still demand. Our vacancies are still all-time low. And so here it's a little different. And that's what I want people to know, because sometimes people make the mistake of saying multifamily is going to go to hell. We need to look at it. Well, in some situations, I can understand why people would say that. And I would say that in California, we're a little more insulated. And part of that reason is we did not overbuild. So if you're a tenant, there's not a whole lot of options for you to go. There's not new construction going on. There's some, but it does not make a dent in the amount of new housing that we actually need. So for those watching, here's what I would say to all that is that I do expect inventory to increase from where it's at today, but know that it's low today anyways. So even if it increases, I don't know that it's going to increase higher than it's been in the past. I'm just saying there's going to be more opportunities. So again, from an investment perspective, be patient. I think the deals are coming. Now, I don't want to make you believe that they're going to be these crazy good deals, but they're going to come on the market. And I'll tell you what, if you're buying from someone who was in a syndication, they might be a little more pressure to accept, to negotiate on that price. And I think there's going to be good opportunities for investors. I want to talk about foreclosures specifically in LA County and in Long Beach to show you what the data really, what the data is really telling us. So in LA County specifically, there's over 3,000 fourplexes, okay, 33,000 fourplexes. And only 58 of those are in what they call pre-foreclosure or what they call notice of default. This means you took the loan out, you failed to pay the bank, they're going to give you a notice saying it's time to pay, right? And yeah, it's time to pay, or they have the option to take that property back. So that's not a big number. Now let's bring that down to Long Beach. In the city of Long Beach, there's 2,800 fourplexes, and there's only 4 that are in that pre-foreclosure status. Only 4. Mm-hmm. So for some of the people watching who are like, yeah, but we're waiving, like the waiver for foreclosures is coming. The notice of default, like that's the actual notice that it's recorded by the bank that we have access to. And obviously here at Sage Real Estate, we're tracking this. We're not seeing an increase of notice of defaults. So we've been watching this for the last 3 years because this is something that we do is we're watching the market. The notice of defaults 3 years ago for fourplexes in Long Beach was 4. Today it's still 4. I'm still not seeing an increase. I'm not seeing a big increase. And in fact, if I look at 5 units and more in the city of Long Beach, not one is in notice of default, not one. Now, someone might say, well, yeah, they're coming in the next 12, 24 months. And that might be a true statement. I just don't believe that it's going to be this overwhelming amount. Right. I think anyone who's a syndicator, obviously they pulled a lot of money together. For the most part, they know what they're doing. Mm-hmm. And they know that if it's time to sell, they have that as an option. They are not just going to let that property get foreclosed on and not end up with anything. Because they're going to say, I'd rather end up with something, even if it's less than what I paid for, than just take a total loss, which is not what they're going to do. Right. Any thoughts on that?
No, I think you're exactly right. I think the foreclosures are not going to spike. I think even if we start to see notices of default, that's still a notice. That's not an official foreclosure, and so somebody receives that and they immediately put their property on the market and they're willing to take a little bit of a loss on it. A lot of these properties are not underwater. A lot of times buyers were putting 30, 35, 40% down in order to buy these properties. And so even if the market has adjusted and they lose some of their equity, they're not, we're not looking at a situation like in 2008 where the loan amounts were higher than the sale prices. And so I still think there's a lot of room there. I think there will be opportunities, but I don't think it's going to be go to the courthouse steps and make your offers on foreclosures. I don't think we're looking at that.
Yeah, no one's going to be giving away their properties.
Right.
Again, they're still worth a lot and there's still demand. And that's the other part too, is that people are under this assumption is that no one wants to buy units, and that's simply not the case. They will buy them so long as it meets the debt coverage ratio, right, which is critically important for financing 5+ units. So that's like the first start. And then the reality is investors know one thing, that when rents go up, the value of real estate goes up, and it's still a safe investment. When we break down this wall of debt of 1.5 trillion, a lot of that, David, is office, and it's hotel, and it's retail. Because once you read these articles, down at the bottom it'll say, yeah, but multifamily is the one that is the exception. And the reason it is the exception is it doesn't have the vacancy and it doesn't have rental growth loss. Mm-hmm. So those two things will make the difference. People will continue to invest in multifamily, but for now, I think our message is you can sit tight and wait for things to potentially get better, or you could negotiate better now. And so if you're working with us or someone like us, this would be the time that if you're looking at 5+ units, look at the properties that have been on the market for a while. And here's one thing that I want you to know, just from an investment perspective. Not every seller is a desperate seller. They're not.
Right.
Some Some really want to sell. Now, that's a small percentage, but, and also just a recommendation, if a property hits the market, don't try to negotiate like really hard during the first 2 weeks of the property. Let the property sit on the market for some time. If it doesn't move, that would be the time that I would encourage you to come in and make sure that it does the debt coverage ratio. And this is going to be the time where you don't necessarily have to wait for the deals to come. I think that you could be strategic now and get the right prices. In fact, we are seeing this. We're seeing this in Long Beach and we're seeing this in other areas. I'm not making a statement that all the deals are good deals, but we're seeing some where like that one was a really good deal. And there was a 20-unit building, David, in North Long Beach just closed. And they paid per door, which is a way that people measure how to come up with value, was $180,000 per door. A lot of things in Long Beach on average sell for $280 a door. So you could see the value there. Those deals are going to come. So again, one thing with being overly patient. Now, if you go back to the numbers that I told you and I said, hey, in 2027, 2028, you have more loans coming due. So you might be thinking, well, then I'll wait for that, right? But the one thing we don't know is that the interest rates could actually drop, right? Mm-hmm. So let's fast forward, it's 2028, you have these loans coming due, but if the interest rates drop, well, then the owner could refinance at that lower rate. The deals never come, right? So I think right now, given where we're at, is locating the super motivated sellers and making that deal work now. I'm not telling anyone to leave multifamily. In fact, I would say this would be the time to come in, be diligent and work with a team, with the right lender, with the right brokerage that knows what they're doing, that's following the market, and that's where you are gonna win. So there you have it, my interview with David Guevara. We're gonna make sure to include his information down below at the end of the video. Now, in the meantime, what were my key takeaways? We know that debt is coming due. Now, it's not this large amount of units, okay? So it's just some, because 159 in the next 12 months is not a lot. So investors are going to be in a tough situation where can they pay the new payment? Do they want to pay the new payment, or do they decide to sell? So based on what I'm seeing, I do expect inventory to go up. If inventory goes up, guess what? We're going to see more opportunities. We, the investors, are going to be able to negotiate. So make sure that you are preparing yourself, you're saving up cash, you're teaming up with some friends. Maybe you take on your own syndication, or you reach out to me and you do something with us. I would love to do that. So being prepared, being diligent, watching, tuning into our videos, because we're going to be watching this much, much closer than anybody else, because this is what we love to do. So there you have it. That's all for now. Make sure to like, comment, and subscribe. Until next time.